Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today we're talking about another SPAC investor presentation, this time Getty Images, which is being taken public by PRPB, one of the higher profile SPACs managed by Chinchu's, got a pretty good track record with SPACs. They took Oots public, and if you remember Oots, the chip company, again, $10 SPAC is currently trading at 16.28, down quite a bit in the last year, but if you bought at the beginning, you're doing well. It peaked all the way near $30, which was, again, during the SPAC mania, and now that SPAC mania has really settled into a SPAC disaster zone because none of these are doing very well. So the fact that this is still trading 60% above NAV, um, about a year and a half after the deal was made. Very good return there. They also took Fidelity Life and Guarantee public via SPAC, which was in 2017. This was way before SPACs were even exciting and amazing. That one was a 1.8 billion valuation. 2 years later, it was sold for 2.7 billion. So again, short-term, decent return, not amazing, but pretty good. Right now, with Getty Images, the stock has basically done nothing. If you bought during the SPAC excitement, this thing went all the way up to 11. Again, pedigree name, etc. Settled around the $10 mark, traded in the 980s for quite some time. And now that the deal has been announced, it's still at 986. Hasn't really moved at all. Don't know when the deal is going to be finalized, but not a great sign trading so far below $10. What we've seen recently is a lot of these SPACs kind of trade below $10. And if that happens, then you've got a lot of redemptions, meaning the company doesn't get as much cash as they wanted to. Potentially the deal has to fail, or they have to raise additional funding via debt, which isn't a good thing for a company that was expecting a good amount of cash. The interesting thing about PRPB is they have about $800 million in their SPAC, so that's a lot of money going towards Getty Images. If there's a lot of redemptions there, it could be a problem. Another thing is that post de-SPAC, which means after the NAV is gone and these companies kind of trade on their own merit based on the new ticker, a lot of these companies have been fallen below $10, which is kind of the new norm with a lot of these SPACs. Again, not all of them, but the market assessment of SPACs right now is in the dumpster. So if you're holding these past the de-SPAC, the risk reward hasn't really been all that amazing. A lot of them are trading below $10, meaning you can just wait and catch them when they're under $10 at a better valuation, even if you like the company. Again, there's a risk with that because not all of these companies will be below $10. Lucid, for example, is still trading at $40. A lot of Oots, for example, is still trading at $16. So good companies will eventually find their way above $10, but there's plenty of SPACs that are down $3 to $4. So if you bought at 10, you're down 60 to 70% right now. Bark, DMS, a lot more to name. SNAX. Actually, some of these are starting to get into a realm where it's like, well, the valuation here is kind of interesting because a lot of these small caps, especially in the SPAC space, have been so beaten down. And part of that is some of the valuations have been ludicrous to begin with. You know, some of these companies aren't really companies. The metals company, a stock that I made a video on, is down to $1.85, right? So if you bought at $10, you're down 80% in like 6 months. It's ridiculous, but that's because this was a dumb company. And again, this doesn't mean that 10 years from now the metals company can't be something amazing, but as of now they have no business. They are not earning anything, and since they're in this spot right now, if they ever have to raise money via additional equity, it's going to be a problem, and that's going to be a problem for some of these SPACs that are not free cash flow positive. So that's kind of the state of the SPAC world. So let's see where Getty Images falls into. Luckily, there's a good comparable here in Shutterstock. If you're not familiar with Getty Images, they're in the stock photography space, stock video space. Basically, if a company wants to buy some photo of a guy riding a bike, they can go to Getty Images, pay them a fee, and use it in a magazine or use it in a PDF presentation or whatever. If a crappy movie is being made, there's a flyover of New York City that they can buy from Getty Images or Shutterstock or Adobe stock. Those are the three big names. Shutterstock is publicly traded. Adobe stock is owned by Adobe, so part of that whole umbrella. And now you'll have Getty Images as another play in this space. The interesting thing is in this space, the multiples have really expanded. If you look at the 1-year return of Shutterstock, it's 58%, and part of that is driven by some growth that you haven't seen before. You went from 16% to 12%. 11% down to 4 and 2 during the pandemic, and kind of before the pandemic there was some slowdown. Now it's back to about 12% in the last 12 months, maybe growing a bit faster if you look at the quarterly earnings results. Let's see if this loads for me. There we go. You're obviously looking at, let's go back, much faster growth in the last couple of quarters. So there's been an expansion of these valuations if that can continue. Decent business here. Gross margins are in the 60% range. Operating margins are in the 13 to 20% range. It is a profitable company, Shutterstock, that is, making net income, probably cash flow positive. If you look at their valuations, though, and you go back to a couple of years, it's an expansion from about a 2x forward multiple on the sales side up to almost 5x right now. So they're taking this public during a time where multiples have expanded, and that's really across the board in the stock market. But it's interesting to see, the question will be, are they taking this public when the multiples are as good as they're going to get? If the growth in this space slows down, if maybe this growth is driven by some extra spending on the marketing side due to the pandemic, hashtag, not hashtag, air quotes being over, which it never will be, maybe that's going to be a problem again on the EBITDA side. 9x multiples, 10x multiples expanding to 20, PE side 22x expanding to 36x, free cash flow 20x to 24x. So pays a dividend here. I could see Getty Images paying a dividend. So let's take a look at this presentation and where these guys are in relation to their competition. Again, Chinchu, this guy's quite known in this space. He's got a lot of decent deals. He had experience in the private equity side, and I think they're actually buying this company from a private equity company. So what is Getty Images? Like I said, they are kind of a known name in this space. If you know anything about stock photography, you know Getty Images, you know iStock. They do have exclusive content. Shutterstock is more about users submitting their images and them selling those images. Getty Images does that as well, but Getty Images is more of a, I don't want to say professional, but high-end provider of these images. They have, photographers on staff, and Shutterstock might as well, but they have exclusive rights to certain things like the NBA, the Olympics, FIFA soccer, BBC, etc. So whenever you see a picture on a news story, a lot of times they'll have that Getty Images watermark. That's why it's there. They're out there on the street taking a lot of photos, as well as taking photography from people like you and I. You can sign up for an iStock account or a Getty Images account or a Shutterstock account or an Adobe stock account and submit your own images that you take and maybe make some money off of them. They take a good cut of the profit, which is why it's a good business for them, not a good business for the content creators, but it does still allow you to make money if you want to do it that way. They are seeing accelerating demand for visual and digital content with significant and growing white space. I think digital content, visual content is the next growing path for this. Photography is still going to be there forever, but video is where things are going, stock video. Although now that everybody has their own phone, those videos can be obtained via other means, right? You can kind of see, even on the news, people will post videos that people posted on Twitter or something like that, going through just nobody, versus going through Getty Images like they have in the past for actual photography on the ground. Rapid acceleration in digital media consumption and proliferation of social media and the creator economy equals extensive long tail opportunity. They may see that as an opportunity. I see that as a threat. Why you go through Getty if you can get an image from somebody on Twitter? potentially for free, right? They don't really know their rights. If somebody uses an image from Twitter, if CBS uses an image from Twitter or a video from Twitter, they should technically be paying that person. I don't really know if they are. You've got an attractive valuation, and again, we talked about Shutterstock 20x forward multiple. They're showing a 15x forward multiple here. So again, if these multiples are stretched, if Shutterstock was 10x 2 years ago and it's 20x now, and they're 15x here on Getty Images, is it a good deal? It certainly looks like a good deal against Shutterstock, but potentially Shutterstock has more growth ahead of it. It's a smaller business, and potentially the multiples are just stretched, right? So 5 to 7x discount on an EV to adjusted EBITDA basis, and you've got a significant value creation opportunity via expertise, data and content driven business, accelerating revenue growth by whatever. Video is mentioned there, increasing focus on AI, ML, and data-driven initiatives, potential for M&A, partnerships, new product offerings, and then significant upside opportunity in NFTs, given Getty's unique and comprehensive content library. They probably have a lot of photos of NBA games, FIFA games, Olympic games. Can they do NFTs out of that? Sure. But I think NFTs are getting a bit overwrought at this point. It was kind of that thing where, wow, NFTs are the next big thing. But now everybody's releasing NFTs. Panini has NFTs. Topps has NFTs. Random people have NFTs. Topps has like 3 different NFTs for different sports on different platforms, and it's kind of a mess. So potentially there's upside here. I think Getty does have a website that could, if they are fast to it, become a platform for trading and selling NFTs. But I don't know if they're anywhere close to developing that. If something like that can happen, certainly there's significant upside there, but they have to be quick on the uptake, right? The NFT platforms that are going to emerge are probably going to become one of there's going to be a big first mover advantage to that. And if Getty isn't there right away, they might miss out. There's already, Coinbase is probably going to have their own NFT platform. There's a variety of others where you can buy and sell NFTs on. And while Getty Images mentions that as an opportunity, they're not saying where they are in that pathway, right? So they do have a subscription business models. A lot of these websites are subscription based. You kind of say, hey, you can buy X pictures per year, or you can pay us X amount per month to kind of get unlimited pictures and videos, whatever. So they are largely probably driven by corporate customers. They're going to continue to expand across that. Upsell videos. I think there is a move towards high value video, and videos are more expensive. They also give the people providing the videos more of a return right now, whereas pictures are kind of becoming less and less enticing for content creators to sell on these platforms. Superior marketing ROI, whatever. AI, ML, and data analytics feels like a buzzword that everybody says, and then partnerships, M&A, and NFTs. It'll be interesting to see what their M&A opportunities are. As I said, I think they are buying this off a private equity owner, and that means they're not going to get a lot of that cash towards their balance sheet. So if there's still a bunch of debt left on their balance sheet, that puts them in a worse position than something like Shutterstock, which has a relatively clear balance sheet, $300 million in cash here, some long-term investments, and then if you look at, do they have long-term debt? Only $52 million of total debt, right? So their net debt is minus $250 million. So it's $250 million to do something with, right? Which makes them more attractive than potentially a company that has a lot of debt. Transaction overview, there we go. Perfect transition. You got an enterprise value of almost $5 billion, 15x adjusted EBITDA, based on a guidance of $315 million for 2022. Existing stockholders other than Koch brothers, is it? Equity Development will roll 100% of their existing stake. Cobra, I don't know. With KED approximately 60, and own with KED approximately 64% of the pro forma company. So equity, KED is basically exiting some of their investment, keeping some in there. All the other existing stakeholders are rolling it over, meaning they're not going to sell, but there is going to be some of this money going to KED. There's going to be additional 65 million earnout shares to be issued, subject to certain vesting conditions, with 1/3 at $12.50, another 1/3 at $15, and another 1/3 at $17.50. So there's some some price targets to reach before that dilution happens. KED will equitize 150 million of preferred equity into 15 million common shares. So they're getting additional shares there via changing some of their common equity. 20% of the existing founder share will be subject to certain vesting conditions, with half vesting at 12.50 and half vesting at 15. So they're still getting 80% right off the bat, but there's going to be some vesting. So some tie to investor returns, and then $150 million PIPE consisting of $100 million from the CCNB2 sponsor and $250 million from the Getty family. So the way this is laid out is you've got $820 million cash in trust, some backstop here, PIPE investors of $150 million and $199 million in balance sheet cash that they have right now. They're paying down a bunch of debt. They're paying out the preferred KED shares, 112 million in expenses, kind of expensive here, and 100 million to the balance sheet. So even after that pay down, you're left with negative 1.1 million in debt. So 1.1 million in debt against 315 million in EBITDA for 2022. You're looking at what, 3.5x future debt to equity, to EBITDA rather, which is, 5x multiple here, 15x multiple on EBITDA, which shows me they have better EBITDA margin than Shutterstock, which is also a 5x multiple, but a worse EBITDA. But they also have much worse debt picture. And this is kind of what happens a lot of these times with these private equity buyouts. It's a lot of this cash has to go to the other company, and sometimes these private equity companies will juice up the growth that you see in order to make this a more attractive sale target by taking on debt and buying other companies or growing much faster than they would via that debt. And then once it goes public, you're saddled with that debt as a public investor, which isn't always a good thing, right? If they're saying, hey, we're going to take on additional M&A to grow this enterprise at a faster pace, well, yeah, they can do that because they are producing decent EBITDA, but their 3.5x multiples are already relatively high. So I don't love that as a holder here. And by the way, I do own shares in PRPB right now. Don't know if I'll hold them forever. There's a lot of good opportunities out there right now. And I'm not sure if this one is one of those that is going to stick above $10, right? Right now, I don't think the risk return calculation of these SPACs are that great. And yes, I could hold. It's at 986 right now. I bought it at like 983, so I have a small return. And I could hold at least until the redemption happens and get $10 back. But that might be 6 months from now, and I might be able to invest that money and get a better than 1.6% return within 6 months. I could take that money out and put it in an I bond right now and get a better return. So it's not necessarily all that enticing. And if that does happen, then a lot of this kind of goes out the window, right? If all of this cash doesn't really go towards this, they might take on additional debt to make this deal happen, and that's not a great thing. The balance sheet is worse than I'd like it to see. It's not the worst, but it's again, it's not amazing. Move the world with images, right? They take pictures, they sell them, etc. They are a global creator. Again, in the creator space, there's content consumers. 45% of them are subscription consumers, and that's almost half of the revenue. And then there's the creators. They have 250 content partners, NBA being one of them, 450,000 contributors, regular people like us. There's exclusive contributors. iStock has a thing that you can select, hey, I'm going to only submit my images to iStock, and you will get more of a royalty from that. And they have 100 plus staff photographers and videographers. So ton of digital assets. Whether they can do anything beyond just selling the stock photos with those digital assets, who knows? Proprietary data, they know what sells. They are in 18 languages and use 24 currencies. Management team. So this is a $900 million business in terms of revenue versus about $750 million in revenues for Shutterstock. So they're getting close to each other. 73% gross margin here versus 64% for Shutterstock. Better gross margin, 32% adjusted EBITDA margin. Do they have an EBITDA margin here? I don't know if they show it, but it's certainly lower, 122 versus 748. What is that? Maybe 17%. Am I looking at the right thing? EBITDA, including unusual items. Yeah, about 17%. So clearly better EBITDA margins here. More mature company, they can probably charge a bit more. Some of these exclusive things that they have are going to just drive the ability to charge higher prices. And also the other company is probably more in growth mode than this company. Company highlights vast demand for visual content, compelling value proposition to clients, premium content offering across creative and editorial, growing customer subscription focus, reinvigorated go-to-market strategy bolstered by improved marketing, deployment, and accelerated ROI. Overview of market opportunity. Clearly, small business invest in social marketing, so they need potentially nice photos to do that. They can buy those from Getty Images, but also they can buy those from a variety of other companies, Shutterstock, Adobe. There's Pond 5, Alamy. There's a lot of smaller players in this space that will probably eventually be bought out by some of these bigger guys and sort of consolidate all this stuff. But there's also free content out there as well, where you can just get free stock photos, and they make their money via advertising and other stuff, and maybe selling some premium content. So they're expecting this total addressable market to grow quite a lot, especially on the video side. And I do think video is kind of the next growth opportunity for them. Where are they selling this stuff? 51% to corporations, advertising, social media, sales materials, websites, etc., media, movies, television, and online videos. Again, anytime you see a made-for-TV movie, or I guess made-for-DVD movie at this time, some of those flyover shots, etc., they're just basically stock photos, right? Cars driving through streets is just stock videos, etc., that you buy from a company like Getty Images if you want to make an article, etc., blah. And then agency advertising campaigns, political campaigns, public relations, sponsorships, etc. So it's just people buying stuff from them that they have in their archive. So they have a comprehensive product offering across value spectrum. There's Getty Images, which is their kind of premium content. There's the iStock, which is where people basically can submit their own stuff. So like I could submit stuff to iStock. It's not as exclusive as Getty Images, which is kind of we have an editorial offering with a lot of content partners and a dedicated team, whereas iStock is more, maybe professionals there as well, but it's kind of like small hobbyists type professionals. And then Unsplash, kind of in the same space as iStock, but it's free. And Unsplash was actually, I think, bought by them recently. So it's a high growth thing. People are using it for free photos when they don't want to pay significant and diverse traffic. And there's deep API integrations, which mean they can connect all this stuff to a lot of creative services and platforms. So this is basically free with a lot of customers. And this is very expensive with corporate customers, and this is kind of in the middle. So they bought this recently. I don't know how much they paid for it, but again, this is not a huge revenue boost for them, but it's maybe a way to upsell some of these products, and maybe there's a way to monetize this in a bigger way, right? Maybe we can add advertising to the website. Maybe we can add premium stuff to the website. So 60% of the revenue is creative, and then 33% is editorial. Editorial just means, news companies that are using their data based on stuff that's happening in the world, and they have their own staff photographers and videographers taking a lot of that stuff. And then creative is, here's a picture of something I designed. I'm gonna sell it on the website. So a lot of this stuff is on the creative side with customers like Disney and Discovery, and a lot on the editorial side is BBC, CBS, Disney, NBC, Bloomberg News corporations, etc. And they have all these exclusive rights. NASCAR, MLB, NBA, NHL, FIFA, PGA. Who's got the NFL? Not these guys. And then they've got exclusive contributors and content partners in Universal, Sony, Walt Disney, Discovery. Can they do NFT stuff with this? Maybe. Haven't seen anything on that front, but there's potentially some upside there. The thing you're hoping for is, obviously the stock market hasn't really cared about this in terms of the stock itself. It's still trading at 986. Maybe if you're holding it and hoping that it starts to move above $10, there's some NFT news that comes out. Hey, we're starting an NFT marketplace. Boom. Stock is at $12 right away. That's kind of what you're hoping for, because if you're going to see nothing until the merger and it's still trading at $9.90 and there's a lot of redemptions, that's a bit of a problem. Obviously their kind of move is to move people towards subscription, recurring revenue, make sure they're paying every year. There's 102% retention, which is very good. It means more people are not only renewing but also adding additional services or buying better subscriptions. And then their long-term target is to have at least 60% in revenue from subscriptions. They've got a complete range of subscription products where you can start with basic, $10 per month for essential images only, whatever that means. And then you've got $115 a month for 10 downloads per month, including premium and video. And as you go higher and higher, you can see where the revenue starts to add up. If you're a corporation, you're probably paying hundreds and hundreds of dollars a month, maybe thousands of dollars a month to get 750 pictures. You're probably taking quite a lot. I kind of want to go to their website and see if I can see how much this stuff costs. So let's say I want to go large images. If I want to get that 10 pack of large images is $4,000. Jesus Christ. How do I get a subscription here? $4,000 for 10 high definition images and or videos. What a rip. Or I guess if you're an investor, good for you guys. Good for you guys. I can't see subscriptions, plans and pricing. It just takes me to this. I would like to see subscriptions, premium access. You got to request demos. I'm too poor for any of this stuff, so not for me. But you kind of see where they make their money. Subscriptions certainly good, but if you just want to buy a couple of pictures or videos in the high definition space, it's still very expensive. You're talking about $400 for a HD 4K video. That's quite a lot of money. Growing the number of customers per $1 million of marketing spend. New customer acquisition for every dollar of marketing spend is increasing, and then customer acquisition costs are going down between 2019 and 2021. So they're becoming more efficient with their marketing, and that's good to see. So really, what are they going to do here? We're going to optimize the sales force, unlock value via cross-selling, customer conversion and royalty, custom content, driving high average revenue per user, and then alignment of sales force and marketing, leveraging insourcing of corporate creative work, and driving corporate penetration and higher average revenue per user. Really, they want to get more people onto some of those premium subscription services, onto those HD 4K products, and really move into the video space as well. That's kind of where the money is. If you look at Getty Images, customers are only licensing 20% of customers are licensing videos. Getty Images, only 7% on iStock. Certainly a lot of growth opportunities there. Probably more money per video sold as well than per picture sold. So certainly where they want to get. And they also have music integrated into subscriptions, providing additional value and upsell opportunities. So that's interesting. I didn't know they actually had music, but potentially music within the video. New customers consuming video 5 to 10% in the last 6 years, and then new customer total revenue from users of video has more than doubled here. And then growth in spend after first video purchase growing quite a bit. And that's really understandable because videos are just more expensive, and they're probably allowing them to realize a lot more revenue per customer for those customers that are spending money on videos. Marketing spend as a percentage of total revenue, they're basically half of what Shutterstock is, which leads to their higher EBITDA probably. And they're getting 3 times greater revenue per customer versus Shutterstock, and better EBITDA versus Shutterstock. Actually, there's adjusted, says it's 29% over here, not 17. So that probably didn't have whatever adjustments they made. Again, adjustments in EBITDA. EBITDA in general is kind of a BS metric, so it's no surprise a lot of these companies use it. Shutterstock, kind of a split across the world, whereas Getty Images is more in the North American, Europe space. They really have to expand beyond those two spaces. Shutterstock is at 209 million over there already, despite having lower total revenue, whereas Getty Images is only 96 million. So opportunity to kind of expand the rest of the world wallet on that space. And then you've got Unsplash, right? Unsplash is an established platform with scaled global traffic and API platform integrations. They have a ton of photos, a ton of downloads, a ton of monthly users, a lot of contributors. Traffic growth has been 58%, 60% growth in downloads. But how are they going to make money off of this? Because it is a free service. Once they monetize it, is it going to continue growing as it's grown? Because once you kind of get your money hands into something that was free in the past, it becomes kind of annoying. They're going to monetize traffic through advertising, expedite monetization through affiliate integration with iStock and free API site integrations, and then launch a branded nano price subscription, right? If you have 27 million monthly users, even if you could get a couple of dollars a month out of a percentage of that, it's a decent boost to your revenue. Certainly not a lot, but if you're adding that up with some monetization through affiliate integration and then some advertising on the website where that didn't exist before, maybe there's some upside there. Just wondering how much they spent on Unsplash. Clearly not already generating a ton of revenues, but hey, we will see. They can expand content and rights. They can expand their market and geographic expansion, move into the free space, move into the rest of the world, add some more data and analytics, kind of move certain things into their customers' minds and try to sell more videos, more images to their established companies. Then you've got NFT and new products and capabilities. They're showing Dapper and a NBA Top Shot. Could they do something like that with their history of NBA photos that they have? They're showing Gran Turismo. They're showing something. I don't know what that is at the bottom promo. It'd be interesting to see what they can do in the NFT space. There's certainly some upside there. I'm just worried that the market's becoming a bit too oversaturated. And if they're a bit late, is anybody going to care? Even stuff like NBA Top Shot, still popular, but it's kind of trailed off, and they don't really have the videos and the new stuff as much. So we'll see what they do there, but they clearly haven't really done anything. But they do own a broad copyright intellectual property, and maybe they could do something with it. It's just a matter of seeing what are they going to do. So strong margins and NFC conversions. Let's get the financials. You've got your revenue growth that has been about 5% since 17 to 2022. Not all that amazing when you consider Shutterstock is growing at a faster clip than that. They're expecting about, what is this? 7% growth between 21 and 22, 6% growth. Actually, what's the red stuff? Upside? I don't know what that's supposed to be. 6% growth, 1. What is the red supposed to be? Why don't you show me? All figures exclude discontinued products. Editorial other. Is this supposed to be other? And they're not showing that? I'm not really sure what the red is supposed to be. Very confusing. Make a better presentation, guys. So you got creative, you got this, you've got 955 to potentially 980 revenue. Not all that impressive, right? You kind of saw slowing growth in 19 and 20 as you did with Shutterstock. But even then, these guys were in the 5 to 3% range. Then you move to 13. Now it's up to 17, 4 to 2 rather than 16, 20, etc. These guys never really grew above 10%, so much slower growth, which kind of explains the lower multiple. The other side of the coin is they do have better margins, which potentially leads to a better multiple on that side. So you got some EBITDA, and really what matters is free cash flow. So their free cash flow conversion here is pretty good. So EBITDA does actually align with profitability in a sense here because they're actually making money. It's not some BS adjustments that you see in some of these SPAC presentations. So you're talking about a company that's pulling in 200 to 250 million in free cash flow every year. CapEx is a small percentage of revenue. They're a pretty good business, right? Anytime you're looking at a business that's in the 60 to 70% margin range on the gross margin side, and in the 30% EBITDA, 25% cash flow range, pretty solid. Their cash flow has actually grown much faster than their revenue. They've become more efficient. EBITDA margin has gone up. which is a good thing to see. There's potentially some room for growth. Really, what you want to see from this company is better growth than you've seen in the past. And the other question is, is this not the norm, right? You're seeing these margin expansions that are good, but you're also seeing growth that is driving multiple expansion in this space that really hasn't been there in the past. The reason these were at 2x multiples on the sales side and maybe 10x multiples on the EBITDA side is because they were growing at, basically 3 to 5%. And Shutterstock was a bit faster than that even. And now suddenly they're growing at 12, they're dropping down to 6. Is this going to drop again and kind of become a normalized kind of inflation grower? Like 6% against inflation of 7% isn't all that amazing. So if that's what you're going to get, maybe these 15 to 20x multiples on both Shutterstock and Getty Images are going to shrink down a little bit. And that's really going to have to play out in order for us to see that. But that's the worry here. You've seen an expansion in multiples on a generally slow growing business, and you might be paying a bit too much right now. And if you wait a little bit, maybe this will become a lot more interesting, because this is still a good business. I do think stock photos and stock videos are a good business. I do like Shutterstock as a stock. I'm just not liking it right now. I wish I owned it a year ago, and I probably would have sold it now. So when I look at Getty Images and the fact that it's a bit less expensive than a Shutterstock, that certainly makes me feel good about my position. But it also makes me worry that these valuations are a bit stretched, because we're kind of seeing a rebound from the pandemic and now more expenditures on advertising as the economy gets going. And if that slows down in a year or two as we go back to normal and these growth rates kind of drop down to single digits, is this still going to be a 15 to 20x business? And I don't think so, unfortunately, right? The one thing I do love about this business, and I love about what Chin-Chu and his team does, is they take businesses that are already generating money. So at the end of the day, even if you buy it today, in the long run, even if it drops to $8 after the de-SPAC, even if there's a little bit of a correction on some of these, if the growth slows, this is still going to be a valuable business as this free cash flow grows, right? You're paying at $5 billion, you're paying 20x free cash flow, which is kind of expensive, but it's still a 5% free cash flow yield, which isn't bad considering nothing in the market really offers that. And this is, I don't want to say guaranteed, but this is kind of a business that's going to keep churning through thick and thin. I kind of wish, even during the pandemic, they did decently. Their free cash flow didn't really shrink. In fact, it grew. So certainly, if there's a recession, there's going to be some cutback in spending. But I think their margins are strong enough that they probably won't be struggling and going bankrupt, even though their debt is a bit of a problem, right? That's one thing that they'll have to focus on. They're going to go public with 3.5x debt to EBITDA. They probably want to lower that into the sub 3x range before they do any M&A. So that'll take a year or two. So you might see kind of blog growth while that happens. I could see this company eventually paying a dividend. They're a free cash flow machine. Once this grows into an X space, why not pay a third of this back, which is going to give you, 1 to 2% yield eventually on something like this. That's my kind of view of what this stock is going to do. Is it going to be a rapid grower from the $10 price? I don't think so. I don't think this is the type of company that's going to suddenly explode and be $20 tomorrow. If it does, I'd be surprised. Unless there's some NFT platform that they release that really looks good and starts attracting people, then that could happen. If their growth accelerates because of something like that, then sure. But until you see that, this is kind of going to be a stable stock that maybe grows kind of with the market. Is it all that enticing at this price point? It's not terrible, but given what's happening in the general SPAC space right now and the risk with this not actually getting all that money after redemptions, I'm not all that excited about this. I will potentially hold this. I'm not sure what I'll do. If I find anything else where this money could be used, I'll use it, because it's basically cash right now, right? It's not going to go far below 986, and I can always redeem it for $10. But there's also some interesting prices out there, some interesting stocks out there that have dropped 30 to 40 to 50%, some of them SPACs. Maybe I put that money into those, and those offer a better risk reward, because at the end of the day, if this thing these SPACs and drops a bit, it starts getting a lot more interesting. If I could get this at $8, I'd be very interested. If I could get this at $6, I'd be super, super interested. This is the type of business that I think is really good. It's just that I don't know if it's worth holding because I don't know if there's any significant short-term upside or if I should put it elsewhere. So long-term, I think this will be still a strong play. I wouldn't be upset about holding it past DSPAC. If it drops, I'd buy more because this is a real business, right? This isn't going anywhere. This is a good long-term business. This is going to be a good long-term compounder. This is going to eventually pay out a dividend. It's just in the short term, there might be a lot of other opportunities in this market, which has punished certain growth stocks quite severely, where your money might garner a better long-term return because this is probably going to move with the market. Where is this coming from? Getty Images for discontinued products and the acquisition of Unsplash. Okay, so they're adding Unsplash and removing discontinued products. So maybe there were products that were in the revenue in like 2017. So is this going to be a blockbuster stock that's going to return 50% in a year? I doubt it, unless there's an NFT marketplace. Is this going to be a stock that's going to compound across 10 to 20 years and do well for you if you hold it? I think so. And I'll probably hold it. That's probably my take on it. I'll see how the market is reacting to DSPACs in the next couple of months. I think DCRN is DSPACing pretty soon. I love that company. They just announced a deal with Shell. I did a video on it a few weeks ago, and I'm still worried that that's going to drop well below $10 just because of how DSPACs are. And I wouldn't be surprised, right? It's still a $1.4 billion company with maybe 80 million in actual revenue that I think is going to grow very quickly with all of the deals that they've signed. But the market is punishing a lot of these companies post DSPAC, even companies that have revenue. Look at PaySafe with probably a 60% reduction since they de-SPACed. But I think Getty Images is kind of more in the UTS area where they're a real business, where they're generating cash flow, where they are getting some cash, paying off some debt that's going to put them in a better position once they're public. But I think it might take a while for this machine to start churning. When are they going to release this NFT marketplace? When are they going to pay down their debt? They're still going to generate free cash flow. They're eventually going to pay a dividend. This is a stock I do like at $10, but would love at like $7. So if there's a post DSPAC crash, this is one I'll definitely be revisiting and buying a lot more of if they start trading in that $4 billion enterprise value range or even a bit lower. I'd love it at that. I kind of like it at this because, again, stable long-term business that's going to grow at X%. That's probably going to return compound long-term in that 10% range as they expand their margin, as they expand their revenue, as they grow their EBITDA by 8 to 11%, pay a dividend on top of that, maybe get some acquisitions. They do have incremental revenue from events like the Olympics and World Cups, etc. And what are they going to do in the creative economy? Can they do anything there? If not, less upside here. But if they can, there's probably more upside than just that 7 to 10% return. And you've got solid cash flow with a target EBITDA, like I said, sub 3x. That's going to happen within 2 years. Good levered tax flow here. That's going to be better after their refinancing. And overall, decent deal here. I'm worried that some of these valuations are a bit steep, just like I am in the entire stock market. If there's a recession, whatever, would I be surprised? No, but I do think having a stock like Getty Images out there is good because I think this is a company that I would eventually want to invest in if the price is right. And the price isn't bad, right? In relation to where the other stocks are trading today, the price isn't bad. In relation to historical values, the price isn't amazing. And if valuation and if growth slows, I could see this drop a bit. But if it does, like I said, I'll be there to pick it up. So my thoughts on Getty Images, let me know what you guys think. Just a reminder, guys, I'm not a qualified financial advisor. Please do your own due diligence before you make any investments. Talk to a financial advisor before you invest your own money. I am just doing this for fun. As with any investment, there is risk of loss, and SPACs have proven to be far more risky than anything else in recent times. So keep that in mind. These guys could drop 30% in the blink of an eye. And while I would be surprised if that happens to Getty, I wouldn't be too upset because at $7, I'd be a big buyer here. At $10, I'm marginally interested and may actually sell to buy other things if there isn't any news in the short term, because I do think there's probably some potential for better returns elsewhere, especially if other SPACs continue dropping down to the bottom of the earth. There's certain companies that I like in the $3 to $7 range that I've talked about before. Genius Sports being one of them, SNAX being another. RDW is another one, although they have some accounting issues that they're working through. I own all of those companies. FYI, I do own PRPB as well. As always, guys, thanks for watching. Have a good rest of your day, and let me know what you think about Getty Images. Take it easy.